Assalamu Alaikum everyone, welcome back to another video. Just want to let you know, just first of all, thank you very much for watching yesterday's video. If you have watched it, I know the sound wasn't great. I was using my laptop and I didn't think the mic had an issue at that point, so there was something going on with the mic. I don't know. My desktop is not working at the moment, so I've just changed everything to the laptop and the mic is behaving differently, but hopefully today's video will be nice and clear. So if you watched that video, thank you so much. Honestly, I know there was a little bit of noise going on in the background. So today we're going to look at a company that I have discovered recently. This company, I do feel like it's one of those businesses where it's a boring business. It's not that easy to understand what they do, and it's not that difficult to actually understand it either. But it's one of those businesses where it's very stable business. They have been around for a long time. They paid solid dividend for a very long time, and it has the growth potential. So it has the potential to obviously grow, and the business model and obviously pay you a stable dividend. So if you're looking for a boring company, you know, just in your portfolio that is stable, that's going to give you that consistent coming in income, then obviously this is a great company, right? So the company that I'm talking about today is Parker Hannifin. This company is in the industrial sector. They do a lot of sensors and monitor, basically control systems. So let's have a look at their business. But before we do that, I just want to show you according to Islamically, this company, from business to debt to cash to receivable compliance, it basically passes all four. So it's Sharia compliant business. So I want to make sure that at least you get that first. These are the products that they sell. So they have so many different categories. When I look at this business, it reminds me of Emerson Electric, which is basically another company I own in my portfolio. So this company here, and this company are very similar in terms of the products that they have in their business. So from aerospace systems to technologies, they have dryers, for example. They sell cylinders and actuators, some stuff about shielding, some stuff about purifying, fitting and quick coupling and so on, gas generators, hoses, and medical and dental equipment. They have motors, drivers, controllers, power takeovers, and so on. They have loads of different products, and they have obviously stuff about monitoring and sensors, and a lot of them, their basically products actually does monitoring, sensors, and basically flow control. Okay, and these products are used in all sorts of industries. Okay, so when you look at the business model and you realize how much they sell, how much products they actually have in their range, is one of those businesses that almost every other business depends on this business to produce this kind of thing. And that's why the industrial sector, I absolutely love the industrial sector, because a lot of companies out there will not have survived without the products of these businesses. Now, when we look at their financials, okay, a couple of things that I want to talk about first. As always, we're going to talk about total revenue for the last 4 or 5 years. So as you can see here, 14.3 billion to 14.3 billion again, and then 13.7, 14.3, and I think this is a lot to do, the dip is probably a lot to do with COVID, but it looks like the trailing 12 months have actually been great, because 14 almost $9 billion. So it is definitely heading in the right direction. In terms of the cost of their revenue, so it's about 10 billion. Consistently, they've been spending about 10.1 to 10.2 to 10.7. Their gross profit, if you can see from here, 3.5 to 3.6, 3.4, 3.9, and then 4 point. So it is definitely heading in the right directions. The net income is also growing as well. So from $1 billion in 2018 to right now $1.8 billion, or almost $1.9 billion. So that's definitely heading in the right direction. Okay, and then what we're going to do is we're going to look at current liabilities current assets from $5 billion to 7 to 4 to 5 now. So 2020 hasn't been a great year, but you can see it's bouncing back again. And then when you look at total, so this is the money they have right now in the bank that they can liquidate and basically use to pay off these current liabilities. So they got 3 billion liabilities, current liabilities, and they have $5.6 billion of current assets that they can use. In terms of their shares, so you can see the common stocks basically at the moment, it's been consistent. So basically they haven't actually bought it back, or they haven't actually issued more shares, which is basically absolutely fine. It's better for companies to buy it back, but obviously you're getting dividends as well, so I'm not worried about that. In terms of total free cash flow here, again, this is the money that business can use to reinvest in the business, to buy back shares, to purchase other companies, to grow the business. Basically they've got about $2 billion. It has been growing obviously from 1.3 to 1.8 to almost to 2.3, and then it kind of dropped till last year, maybe because of COVID, or maybe because they made a purchase or other things has happened in the business. So in terms of the financials, it actually looks a very stable business, and is very similar to, for example, companies like 3M and Emerson Electric, all the industrial companies out there. When we look at the analyst and what the expectation is for the next couple of years for this business, okay, so in terms of from sales, you're looking at about 9.1 to 6 for the next couple of years. So you basically is a huge company. It's been around for a long time. It's going to grow about 9% sales wise, and then another 6% of the following year, and that's the expectation. That's normal for this type of business, because they're not like high flyers, they're not the Teslas, they're not the Squares and all of these businesses, okay. And then when you look at the growth side of things, current year about 17%, next year looking about almost 11%, the following 5 years you're looking at per annum or basically 11%. So every single year the business is going to grow about 11%. Again, very, very nice, very stable. When we look at the recommendations, or what they think in terms of the analyst, what they think about the business and what they think about the price, the shares of the this business right now, they think about $370 per share. Currently it's $302. So it had a massive dip, because from the highs, I think the highs, if I'm correct, it was almost $330 something per share. So when we look at the 52-week range, the lowest it's been is $247 per share. The highest is $334 per share. So you can see it's actually it came down quite a bit. And last week, Friday, it actually came down about 3%, or almost 10 points there. So yeah, so it's actually, it looks like undervalued at the moment according to this, because if you're looking at the price, $370 per share, that's $70 up from where we basically are right now. Let's have a look at what Morningstar and other companies are saying as well. So it looks like 396. So again, fair valued at the moment. So it looks like it's a fair value there. According to Simply Wall Street, apparently the company should be trading about $518, and that is almost a 42% undervalued at the moment. Again, I don't know what they know about this business, but hey, that to me, that's amazing. If they can grow from 500 to 40, that's $218 or $216 top of basically what you're paying for right now. So like I said at the beginning, the company has been paying their dividends for a long time. It looks like it's undervalued at the moment. And then when you look at tip rank as well, you've got 369. So 370 from 300 right now. That's quite a lot as well. That's a massive upside. But although, and they've saying moderate buy, and when you look at the couple of the analysts that are looking at this business, there's not that many, but they're looking at and they're saying basically 25% upside, 50% up, 51%. 13%, 11%. So everyone, they more or less agree the fact that it should be higher than where it is right now, almost to $340. So the person who said is hold said $340 per share. That's $40 more than where it is currently. So it looks like it's great business and is actually undervalued at the moment. So, and on top of that, you get a solid dividend. Let me show you. So they're very safe. So 94 out of 99. They grown in the basically dividend growth side of it, 17%. They're growing about 17%, and that's very fast. Dividend yield is only 1.36. And when you look at how long they've been paying this dividend, you'll be surprised. 65 years of paying that dividend. Okay, they've increased it during recession times. Okay, recession sales is on about 25%, and recession returns is about 62%, minus 62 or minus 25. So yeah, this is a solid business. It's very similar to, like I said, Emerson Electric at the moment. Because I have Emerson Electric, I don't know if I should add this company. I do like the industrial sector. I do have quite a few stocks in there. So I've got like 3M, I've got Emerson Electric, and then I've got Cummins, for example, that develops engines and so on. And then I've got where is it? Here we go. Union Pacific and Waste Management as well. So all of these companies are really great companies. They paid excellent dividend. They have been around for hundreds of years. Okay, and because of that, the business model is actually very stable and they're not very speculative. But one thing I'm definitely going to mention about this company is, right, you really need to be careful, is the beta. And the beta basically is 1.7. 1 or lower is what we're looking for. 1 means if the stock, so if it's a 1, it goes with the market. So if the market is down 10%, then it will go down 10%. If it goes up 10%, it will go up 10%. If it's more than 1, then that means there's more. When it goes up 10%, you'll probably go up, this stock will probably go up about 15%. When it goes down 10%, the overall market, it'll probably go down about 15%. So it's a lot. So, but this looks like but that's normal. Even Emerson Electric has similar sort of beta. There we go, 1.51. So they are very cyclical, meaning they are actually, if they fluctuate, when you look at their prices over the last whatever year. So if I just click you can see there's ups and downs, up and down, and so on. Whereas if you look at the consumer staples, for example, the defensive stocks is more or less just either going up or just goes up a little bit every couple of days, and 1% up, 1% down. It's not as fluctuates as much as these companies. So yeah, that's the next company that I want you to bring to attention to. Should I be buying this company? Possibly. So I might be adding to, maybe just get a couple of shares and just monitor the price and see if it actually goes down below where it is right now. Okay, because I do like the business. It's only 38 billion or 39 billion market cap. They have solid business model. They have been paying their dividends for a long time. This is the type of company that I just like to buy. Let this basically dividend grow, carry on. Is boring, no one likes it, but that's fine with me. Like, some people will say to, why you only 35, why are you buying this type of company, why are you not buying the high flyers? Well, when you look at my portfolio, I do have those high flyers. I'm looking at Adobe's and Microsoft and the other companies that have KLA, for example. I've got MasterCard, I've got Visa, I've got what else do I have? I've got Qualcomm in there. So, and then I've got CrowdStrike on the other, TSM and so on. So all of these companies are high flyers, but you kind of need to balance your portfolio. So you should have some stable companies that you like and that will stay there forever. And I'm not basically buy and hold and then sell it straight away. I'm buying to basically hold these companies for probably another 5 to 10 years, unless the business model has changed or there's no growth. And like, for example, Kimberly-Clark was one of the great companies that I actually owned for about a year and a bit, but it didn't do anything for me for that year, and the future doesn't look that great. So I took that money and put it into somewhere else, and that's normal. Okay, that's something that you should be thinking about. I'm not saying you sell your stock, but hey, sometimes you need to look at portfolio and see what's working, what's not working. And if it's not working, then take your money out, put it somewhere else. Anyway, that's Parker Hannifin. Hopefully you like the business. Like I said, it's definitely a Sharia compliant. They have millions of different products. They look like the type of companies that I would definitely buy. I'm going to look into it in the next couple of weeks and then see if I can add, maybe just purchase a couple of stocks of this company. So hopefully we'll see how that goes. I hope you have a great day. Assalamu Alaikum. Take care.